In this video, we're going to discuss the concept of the cost of capital. Determining the cost of capital is an essential component in a business's capital budgeting process. Capital budgeting is the process of determining which projects a business should undertake. Should they buy a new piece of machinery? Should they expand their operations to another location? Should they offer a new product to customers? All these are capital budgeting or investment decisions. The process starts with a simple question: should we start a project? And we can go about answering that through a series of steps. The first step will be to analyze the cost. The cost here is not the cost of purchasing equipment or raw materials or anything physical like that. This is going to be the cost to get the money necessary to do the proposed project. Another word for money here is capital. It costs money to acquire capital. The next step will be to analyze the benefits. If we do the project, what are the cash flows we expect to come of the project, and what are they worth today? The final step will be to make a decision. Yes, we should undertake the project, or no, we should not. We're basically analyzing whether the benefits we estimate from the project exceed the costs. We're going to focus here on step one: how much does money or capital cost? In order to start a project, let's say for example Nike is thinking about constructing a new factory, they'll need money to do that. Where would Nike get the money? From investors. But investors are not going to give Nike the money for free. They're going to demand something in return. If Nike borrows from a bank or sells bonds, the lenders will demand some compensation, some interest. If Nike sells stock, the owners of the stock will demand compensation too. They're going to want a piece of the profits, dividends. These are both costs. The rate of return the investor receives is the same as the cost the business pays, two sides of the same coin. And the cost the business will pay for capital is related to their riskiness. The riskier the company is, the more return investors will demand, and if investors demand higher returns, that means the business is paying a higher cost. We can represent the cost a company pays to get money by the weighted average cost of capital, oftentimes called the WACC. And the WACC is the average cost the company will pay to capital providers to finance the purchase of its assets. Why do we have to compute an average? Well, a company can get capital from many different sources. They can borrow with bank loans or bonds. They can sell equity and issue different types of stock. Each one of these sources is going to have a different cost, which is determined by the market. If they sell bonds, investors may demand a 5% rate of return. If they sell stock investors might require a 10% return. So with the weighted average cost of capital, we're going to weight the cost of each source by the proportion of capital which comes from that source. So for example, if 80% of the company's funding comes from debt, we'd weight the cost of debt by 80%. To compute WACC, we'll simply calculate the weighted average. We'll find out what percentage of our total capital comes from debt and multiply by the cost of debt. We do something special here and multiply by the after-tax cost of debt for reasons that I'll explain in a little while. The next source of capital will be preferred stock, a type of equity that I'll describe in a little while too. We need to find out what percentage of total capital comes from preferred stock and multiply it by its cost. And lastly, we'll take the percentage of total capital that comes from common stock and multiply it by its cost. So altogether, we've computed a weighted average of the costs of all of our capital, where the weights are those proportions. We'll look at each of the equation's components separately. We'll start with the cost of debt. The cost of debt is the yield to maturity. Remember, yield to maturity represents the average rate of return an investor would receive from holding the company's bonds. If an investor is receiving this return, it must mean the company is paying it. So the yield to maturity is a cost to the company. We need to find the after-tax cost of debt because debt has a special treatment in our tax system. Interest expenses on debt are tax deductible. So there's a tax shield associated with debt. The more interest expenses we have, the less tax we'll pay. So it works out that the company's not going to bear the complete burden of their interest expenses. Some of those expenses will be balanced out by tax savings. And since we want to know how much money costs to the company, we need to compute the total cost, which is going to include those tax savings. We can make a simple adjustment to find the after-tax cost of debt by taking the yield to maturity, which is denoted RD, and multiplying by 1 minus the company's marginal tax rate. That gives us RD star, which is going to be the after-tax cost of debt. So for example, if the yield to maturity on Nike's bonds was 8% and their tax rate is 40%, their after-tax cost of debt would be 8% times 1 minus 40%, which is 4.8%. That 4.8% represents Nike's cost of debt after taking into account the tax savings associated with debt. Just to make sure we're clear on what I mean by tax savings associated with debt, I want to do a simple illustration. Let's say that Nike borrows $2,000 and that debt has an 8% interest rate, and their tax rate is 40%. We can first imagine a world different than the one that we're currently in. In this world, the tax laws do not allow interest expenses to reduce your taxes. So our interest expense would come after the tax on our income statement. Notice that if interest goes higher and higher, it would have no effect whatsoever on taxes. Next, imagine the world that we currently have, where interest expenses are tax deductible. Here you'll notice that if interest expenses increased, then tax expense will decrease alongside it. Now notice the difference in taxes between the two scenarios. In the first scenario, Nike would have to pay $400 in taxes, while in the second scenario, they only paid $336. So $64 less tax was paid due to the tax shield. We can take this information to get back to the after-tax cost of debt formula we presented earlier. In the numerator of this fraction here, we have how much it cost Nike to borrow the money. They had to pay $160 in interest, but remember, they'll get something back. They'll also pay $64 less in taxes. So how much are they effectively paying to borrow? That'll be $160 minus 64, and we can divide that by the $2,000 they borrow, and that gives us 4.8%, which is the same as the after-tax cost of debt we computed earlier. The next source of capital we need to deal with is preferred stock. Preferred stock is a form of equity. It represents ownership in the company, but it's considered a hybrid security because it carries features of both debt and equity securities. Like debt, it comes with a fixed payment. Just like interest expenses on bonds are constant and never change, the dividends on a preferred stock are constant as well. In the contract for a preferred stock, it'll specify the size of the dividend that will be paid. Also, like interest on debt, dividends on preferred stock must be paid before anything goes out to the common stockholders. There's a priority structure in who gets paid before who, and preferred stockholders are in front of common stockholders in that line. Since it's a hybrid security, it also has equity features. What happens if a company fails to make the required payments on its debt? The consequences can be huge, and it could even force the company into bankruptcy. In contrast, a dividend on preferred stock can be missed without severe consequences. So just like other types of equity, it's up to the company's discretion whether or not they're going to pay dividends to preferred stockholders. And just like other equity, there's no expiration date on preferred stock. Preferred stockholders are owners of the company, and as long as the company exists, they will remain owners. With the way we've described preferred stock, you should have a general idea of how to value it. It pays a fixed dividend and does not expire. So for a basic share of preferred stock, we can value it like a perpetuity. Since we're interested in the cost, we can rearrange the perpetuity formula to solve for R, the required return. And this will be the cost of preferred stock. We can do a simple example here. Let's say a company issued preferred stock with a $5 dividend, and these preferred shares are selling for $80. We can find the required return by taking the $5 dividend and dividing by the $80 price, giving us 6.25%. That's going to be the cost of this company's preferred equity. Lastly, we need to deal with common equity or common stock. There are two ways to estimate the cost of common equity, and we're already familiar with both of them. We can use the capital asset pricing model, CAPM, or we can use the discounted dividend model. Let's use the CAPM first. The capital asset pricing model says the required return on a company's stock is equal to the risk-free rate plus the company's beta times the return on the market minus the risk-free rate. So we need to find out each of these components. Let's figure out the required return on Nike stock. We need a risk-free rate, so I'll use the yield to maturity on a 10-year US Treasury bond. This is a common proxy for the risk-free rate. Next, I need Nike's beta. I can compute that myself by running regression, but this information is also freely available, so I got this from Yahoo Finance. Nike's beta is 0.81. The last piece of information I need is the stuff in parentheses, the return on the market minus the risk-free rate. This is called the market risk premium. There are a few sources that estimate this value on a regular basis, and I got this information from KPMG, and they estimate the market risk premium for this year to be 6.75%. Putting all this into the CAPM formula, I get 6.29%. This is the required return on Nike's equity. If investors are going to give Nike money in return for ownership, they're demanding a 6.29% rate of return. Said differently, that's what it's going to cost Nike to get money from this source. We can also estimate the cost of equity using the discounted dividend model. We can start with the constant growth model and rearrange it to solve for the required return. For example, let's say a company that currently pays a $1 dividend and has a stock price of $20. If dividends are expected to grow at 5% per year, what's the required return? Well, we can input that information into the constant growth model, solve for R, and we get 10.25%. That's the estimate for the cost of equity. One thing I want to point out is that retained earnings are not free. Remember what retained earnings are. They're the profits the company has earned that have been reinvested back into the company. Say, for example, Nike generated $100 million in profits and used some of those profits to purchase a new factory. Many people think that because Nike didn't have to go to the market to get any of that money, then it didn't cost anything. But it's important to remember that those profits belong to somebody. Those profits belong to the company's owners, the stockholders. Nike is just reinvesting those profits for them. And just like the stockholders demand some rate of return on their stock, they're going to demand the same rate of return on their retained earnings. So retained earnings are not free. The cost to use these funds is the same as the cost of common equity. Now that we've estimated all the costs, it's time to estimate the weights. The percentage of our total capital, what's the percentage of total capital that comes from each of these sources? It's first important to define what counts as capital here. Capital is going to specifically refer to long-term investor-supplied funding. So a bank loan and bonds are going to be capital. And common and preferred stock will also be capital. But accounts payable would not be considered capital because investors are not providing that funding. Remember, accounts payable would be like if a supplier gave you some raw materials today and you're going to pay for them later on. Technically, they're loaning you money, but they're not an investor. So we don't consider that capital. Similarly, short-term notes payable would not be considered capital either because they are short-term funding and not long-term. We can compute the weights like this. The weight in debt will be the market value of all the company's debt divided by the market value of all of its capital. And for preferred stock and common equity, it's the same thing. The market value of each of those divided by the market value of all capital. Let's figure out the weights for Nike. Getting the market value of common equity for a publicly traded company like Nike is pretty simple. It's just the market capitalization, or market cap, of the company. We take the current stock price and multiply by the number of shares outstanding. So for Nike, it will be $120, that's price per share, times 1.25 billion shares outstanding. So the market value of Nike's common equity will be $153 billion. If you're trying to do this for a company with no publicly traded stock, it's going to take a little bit more work. We'll use something like valuation by multiples, and that might give you a decent estimate. Next, we need the market value of debt. Finding this market value is really challenging in practice because most companies get their debt from a variety of sources. They'll have some bank loans, some bonds with collateral, some bonds without collateral, some 10-year bonds, some 30-year bonds. All of these are going to have different market values. So for simplicity, we could just use the aggregate book value found on the balance sheet as an estimate for the market value. It turns out that this isn't too bad of an estimate in practice. Looking at Nike's balance sheet, they have $3.4 billion in long-term debt. This is going to be our estimate of the market value of their debt. Finally, preferred stock. Again, if this is publicly traded, finding the market value is simple. We'll just multiply the price per share of preferred stock by the number of preferred shares outstanding. If they're not publicly traded on the market, the value of a simple preferred stock can be estimated using the perpetuity formula. Let's put this all together to get weights for Nike. We estimated that the market value of their debt to be $3.46 billion, and the market value of their common equity is $153 billion. And Nike has no preferred stock. Summing all these together, we have a market value of all of Nike's capital as $156.4 billion. Now we need to convert those those values into weights. The weight in debt, WD, is the market value of debt, $3.4 billion, over their total capital. And so we get 2.21%. 2.21% of Nike's total capital comes from debt. $153 billion is going to come from common equity, or 97.79% of Nike's total capital comes from common equity. And 0% comes from preferred stock, since they have none. Finally, we put all the pieces together to get Nike's weighted average cost of capital, their WACC. We got the costs earlier, and they're seen here. We just need to weight them. 2.21% of Nike's capital comes from debt, which has a cost of 4.8%. And 97.79% of their capital comes from common equity, which has a cost of 6.29%. So the weighted average cost of capital for Nike is 6.26%. Let's think about this for a minute and think about what this number means. If Nike wanted to raise money to construct a new factory, they'd have to get funding the way they've done in the past, a little bit of debt and a lot of common equity. Taking into account the current market cost of these sources of capital, Nike would have to pay, on average, 6.26% to raise capital. That is the weighted average cost of capital.